In this problem, I'm going to demonstrate how a merchandiser accounts for shrinkage using an alternate version of Quick Study 411 to demonstrate. So here we have the ledger balances as of their fiscal year end for Nixit Company. And we also note that Nixit Company uses a perpetual inventory system. And being that it has a merchandise inventory account and cost of goods sold, we know it's a merchandiser. Being that it uses a perpetual inventory system, merchandise inventory should already reflect the increases and decreases of inventory. So when they bought inventory throughout the year, they would have debited merchandise inventory as an asset account. And when they sold it to customers, they would have credited merchandise inventory and also debited cost of goods sold. So theoretically, we should be able to go out and we should have, according to our balance here, $38,300 worth of inventory. But in the real world, over that 1 year time frame, there could be some differences. So we could have had some errors in record keeping over that year. We also could have had what we call shrinkage. So maybe those items are perishable and some have just gone bad. And so we don't have as much or as valuable inventory. The other thing that can cause shrinkage is theft, whether that be some combination of both customer and also employee theft. So even a company that uses a perpetual inventory system still needs to go out and do a physical inventory or physical count of its inventory and value it at least once a year, typically at that end of the year, because again, we expect over that time frame that there are going to be some differences. So this company went out and did that physical count and valued its inventory of 37,100. Being that it's lower than the balance it had in its general ledger of 38,300, Nixit does have inventory shrinkage. So what are we going to do with that? We can't just leave the balance as is. We've got to make an adjusting entry to reflect the value of inventory they actually have. So let's think about this. Merchandise inventory right now in the general ledger, it's an asset, has a debit balance of 38,300. What do we need it to be? We need it to be the actual value of the inventory we counted, which is 37,100. How do we get it from a debit balance of 38,300 to a debit balance of 37,100? We need to credit or reduce merchandise inventory for the difference between these two values, which is a difference of $1,200. So we need to credit merchandise inventory for 1,200, again, to bring that balance down to 37,100. So one side of our adjusting entry to deal with inventory shrinkage is crediting or reducing merchandise inventory in this situation by $1,200. Now, you know by now in this semester that you can't have a debit without a credit or credit without a debit. So we need to debit something. What account are we going to debit? We are going to debit cost of goods sold for the same value of $1,200. So let's step back and think about this instead of just memorizing. We're crediting or reducing merchandise inventory because we lost inventory over that time frame during to shrinkage. We're debiting cost of goods sold. Cost of goods sold is an expense. Debiting it means we increase the expense account. If we lose inventory, we're increasing the cost or expense of our business. So that's a logical reason why we're increasing cost of goods sold. What's the cost of goods sold balance? I know the problem doesn't require it, but your next problem on closing entry related to this, it'll be helpful. It previously had a debit balance of 105,300. We're debiting it or increasing it by an additional $1,200 as a result of this adjusting entry. So the resulting balance after the adjusting entry of cost of goods sold, it increased to $106,500. Now, the next video in this series is going to deal with the closing entries after we've already posted this last adjusting entry.